The Startup Cabin podcast is brought to you by Cedarwood. Cedarwood rents out senior CFOs to the tech industry from 1 to 5 days a week. For more, go to cedarwood.co. Welcome to the Startup Cabin podcast, where we share great insights from European startups and investors. I'm Steve Ferris, and in this episode, you get to hear insights gathered from over 30 years in the venture capital field, and we couldn't be more excited to share it with you today. In this interview, Xue Mei Rhodin will be talking with Lennart Ohlsson, who is co-founder and general partner of STOAF, the Stockholm Business Angles, and they are a venture capital group with 30 business angels who are based in Stockholm, Sweden. Lennart has written 20 books on economics and venture capital, and because he knows this stuff so well, he's able to explain it in really simple terms that will hopefully give you a little more understanding into the process of venture capital. So here's the interview.
Welcome to Startup Cabin podcast.
Thank you.
So can you tell our listeners a little bit about yourself?
Well, what made me do what I'm doing is that I started as a researcher in economics and was invited to Stanford in the 70s. And there I met privately with people investing in ventures. And that got me interested in the field. But as a researcher, I continued for about 10 years before I had anything to do with ventures in Sweden.
So did you research on ventures?
No, not at all in the beginning. That came much later. And that had to do with what I got funding for. I've written about 20 books. And the last ones are on venture capital. And the one I'm finishing this year is also on venture capital.
Is it specifically about the Swedish market or?
This one on best practice venture capital is relying on interviews in Silicon Valley with people I had come to know and who were venture capitalists there. Very high returns in their funds. So I claim they were doing the best practice in the market. And then I could compare it with what I was myself doing. So it's a combination of research in Silicon Valley about the methodology there and what I could figure out as an economist when I analyzed why are they doing this way.
And what was the best insights?
Oh, I have one guy who is incredibly clever. And more and more I came to rely on him, so all the difficult questions I put to him. Sometimes he gave me a mysterious answer. And then I couldn't figure out why he answered that like that. And I might be sitting on the flight back to Stockholm before I understood why did he say that. And so it's much, for me, an internal process of getting an understanding of the field. But you can't do that unless you also practice it. So that's why I got interested in participating as a co-founder or advisor to business angel companies.
So when did you start with that?
1983 or 84 in Uppsala. It's now a company owned by many shareholders, but it's listed in the stock market, and Anders Wall is the main owner. It's called Beijer Alma. And so that was my first experience. And I have now been involved in helping 7 business angel companies start.
Wow.
And this one is the 5th. and one stock market. So.
Cool. And now you're on Stockholm Business Angles, STOAF. Is that a full-time practice for you? Or?
Yeah, at least full-time, yes.
At least full-time.
When I'm in Sweden, I work on average probably between 40 and 50 hours a week. Mm-hmm. I'm obliged under contract to do half-time, but there is no limit to how much you can do when you work in this field.
So how many companies do you have that you manage in some way in STOAF currently?
In the first fund, we invested in 11 ventures and closed 4 new investments in January of 2013. We opened the second fund in April the same year, and we've made 8 investments there. So that and one is common to both, so it's 18 investments.
So what's the hardest part with having so many companies to deal with?
The hardest part? What could that be? Well, yeah, I participate in the selection of the ventures and deal design. And after that, this is hard to say, but I kind of lose interest in the sense that my passion is gone.
Okay.
So it becomes more a practical thing for me to follow up. Other of our angels get involved, and they love that. So I can relax that part. But when something happens with a venture, good or bad, then I get involved again. So I have noticed I get more and more driven by whatever passion is driving me those periods.
Is it the excitement? I mean, if you're doing a turnaround case, that's pretty exciting, and it's a problem to solve.
We've had a venture that was growing so fast that we couldn't plan when they needed more capital. So the CFO of the venture took contact with me and said, "We need money." And then you have to work fast. So we could raise what they needed in between 4 and 6 weeks. And, you just have to do it and get to work the next minute, basically.
Yeah. So, and I mean, that's very fast for doing an investment, right?
That's fast if you have a group investing. And sometimes we needed to go outside of our fund investors and approach our external network. So then it takes even more time because you have to find out first how much money you can raise internally. So and that kind of stuff I've been involved in. And also sometimes a venture does not develop like you had hoped for.
Yeah.
And there is some kind of crisis because some investors lose confidence. And usually those who lose confidence are either those misinterpreting what has happened, and they are not informed. So you have to work fast and deep with both the investor side and the founder side, and then try to find a financial design which makes the partnership hold together as much as possible. And that's sometimes tricky, It sometimes means that you have to sit with each one of them and go deep into the discussion and find out the opinions. And I tend to say you don't know the value system, the deeper priorities of a human being, unless that human being has a crisis to deal with. Then you know the priority order, and then you can deal with it. But if you just take superficial communication, doesn't work in those situations.
It seems like I'm a business advisor, and I get a lot of startups who come to me, and they want to do investments, and they think it's kind of like, buying a snack at 7-Eleven. They think it's, I need cash in 2 months. Well, 2 months, you don't even know who you want in your company. They have a very superficial view of what venture capital, what business angels do, what the relationship is about. I don't know. I don't know what's really has gotten it to that point, because there's no investor who tells them that.
No.
Everybody says the other way around.
Yeah.
So I guess it's media in some way.
And we're still not very good professionally in Sweden, on both the entrepreneurial side and on the investor side. We have very good examples that are sort of shining, but in general, the level of know-how is too low, and that's why we built Stockholm Business Angels, more as a very good professional actor in the market than with much capital. So we have divided our angels in 2 groups: those who only want to invest and stay passive, and those who want to get involved. And we have about, I think, close to 30 what we call competence partners. And they are obliged to educate and do case training during the time they educate. Before then, we can't use them much. And the capital partners, it turns out, tend to be people who are interested in learning too. So they do it voluntarily. And one of the reasons is that we have an open syndication model, so they can co-invest with a business angel company. And then it's good to know how the competence partners function, what the terms are they are using, whether to trust this team or that team. So it turns out that nowadays we are selected by investors very much because we take that responsibility of teaching people.
They want that added value.
They want added value to their money, not only returns on investment.
And especially as you invest in pretty early companies?
Yes, we have gone into very early companies before even they have a product. And we usually guide them through the early stage. But we have an investment now that is signed this week when it's not that case. But and then it's more complex, and we could use the skills of one of our shareholders to combine with our know-how in new ventures.
So how did Stockholm Business Angles start? You as founders?
Well, I was involved. I was at the Royal Institute of Technology at the Center for Banking and Finance. And as such, I was helping out business angels elsewhere in Sweden to set up a company and start investing. So I gave both advice on how to set up the company and also how to select ventures. And then one guy came to me one day and said he was related to a big project that was to start in Botkyrka. And Botkyrka is the commune around Stockholm which has the highest share of immigrants, and he was himself a successful immigrant. And so first we tried to set up a company there, and it didn't work. The whole project collapsed because of lack of funding. And then a few months later, he came back and said, why don't we set up a Stockholm Business Angel group instead? And I said, well, if you can find the investors. And, the difference between Stockholm and regions outside is that there is no passion about helping out renewing Stockholm businesses. Why is that? Well, Stockholm is pretty much able to take care of itself, whereas in other parts of the country, their industries are contracting and successful entrepreneurs want to help out. So we had to gather around a different concept, and that concept became that by combining people's money and skills, we were more attractive to ventures with high potentials. So we said, we're setting this up in order to find home run candidates. And if it doesn't work in 3 years, we close it. And the other purpose some of them had was that they wanted to learn the skills. So that's why I became the chairman of the investment committee, because I could control the teaching and learning in that context. So after less than 3 years, some of the business angels said, well, we think this might work, but how do we scale the business? And then we set up the process leading to the scaling. And it took us 2 years before we had the right model and could close the first fund and then continue to work with what was in the fund. Looks as if that will give a good return on investment. So we have a higher share of complete failures, but also a higher than normal share of possible home runs. So,
and you have courses also to become a business angel or learn more about this.
I've had courses at the Royal Institute, a couple only, and elsewhere. Writing books in a university environment you can't do unless you get involved in seminars at least. And I like to teach, but I primarily have liked in my years to give talks, on new subjects, because that's I have a big nose, and the big nose leads me into new areas to investigate. And so it's very much driven by curiosity.
So how long do you think it takes to become a good business angel?
A lifetime. I mean, it has taken me a lifetime. If you're really interested in the early phases of a venture, you have to learn all the time, because there are new types of ventures coming. And my main teacher, who actually gave us a talk when we as a group came to San Francisco and Silicon Valley in March, he said on one occasion when I said to him, how could you keep up with all the new technologies in your field, because it changes so fast. He was in information and communication technologies. And he said to me, it's all about principles. And that was one of the times when it didn't stick with me when I was doing the interview. But afterwards, when I came back to San Francisco, I started to think, what did he mean? And, I was too shy to give him a ring. So that it led me into, trying to find out what could the basic principles be. And on the flight back to Stockholm, I said to myself, it must be the economics of investing, because technology does not have guiding principles if the field changes a lot. And of course that made me even more convinced that I should write this book. This book is an idea from around 1987, and it was published in the year 2006. So I didn't get the opportunity to write. I had to go back to the university in order to be able to write, because the business organizations where I had been for 15 years, they didn't want me to write a book on best practice venture capital. It's only now it's become popular with business organizations.
It seems like a very kind of vague field, that there's not a set road where this is how you do it to become a business angel. It seems like it's kind of has to become kind of a personal interest like this, and then it kind of evolves. I have never heard someone, this is the way to become a business angel. It seems like...
My wife said to me when I said I will write a book, and she said, maybe it's time for you to write a book that earns some money to you. And I said, yeah, that's what I like. And so I started to write it, kind of trying to combine a little bit of cases and then, principles, and it was completely impossible. It took me 7 calendar years, and I spent 3 full working years on finding out. And the first part of the book is on how you prepare for your investment, the methods that are used in Silicon Valley, and why they have used these methods for so long. Second part has to do with first mover analysis and how first mover advantages are either strong or weak or so on. So that's basically a series of simple, what I call thought models, upon which you can structure your own thinking.
Can you explain for the listeners about first mover?
First mover is, for instance, a company that brings a new technology to the market, or an idea like Facebook that is based in an idea that people are interested in social interaction. And then he used an existing methodology, basically, developed, but not very unique in the beginning. So it could be anything that brings a new venture to become an early mover in the market. But the first mover concept is actually a concept which unifies a large number of different types of first mover types. And you have to figure out the venture properties first in order to characterize it. And much of what I have been able to do in that book and in the book that I'm finishing now is to develop a whole framework of concepts, methods, and tools that can be used in the analysis you need to do before you invest.
So you have been a business angel and been in investments for so long. What do you see is the difference now compared to before? Well,
in the beginning, I felt, even though I was not very good at all, I felt I was ahead of the crowd, and now I feel stressed by not learning fast enough.
Okay.
Because there are so many now that are learning at least part of the field, and there are so many different types of ventures that people are specialized in, and which I don't understand yet. So that has been a feature. It's only, I'd say 3 years since the Swedish market was not very well developed. And now suddenly there is a surge. It's similar to what I experienced in late 1998, I think it started, and became a boom and a bubble. So it's similar features. And this guy that I trust as a very knowledgeable guy, he claims there are 15 years in the cycle in the business, in the venture capital market, and that we're now in a peak situation.
Okay.
Whether there will be a steep
Fall.
downside of from the peak or not, he cannot say, because it varies so much between the fields. But there are some fields where we have noticed in Stockholm Business Angles that the valuations are much too high. And other fields, they have stayed as we have experienced it since we started.
So which have changed?
Well, everything you can read in Veckans Affärer or Dagens Industri, those fields, there you see the valuations are climbing. They don't write about medtech, so the valuations stay as they have, and they are based on sound principles.
What do you think about these companies that they have, gotten investments and they have a technical product and they have users, but they have no revenue model? There's a couple of those around, and they kind of stay afloat while pretty much burning money from investors. How do you look at those kind of companies?
We like to understand the business model they will apply. It's not always a requirement that we also believe 100% in that model. But as long as they stay communicative and listen to advice, we might invest anyway. But we have almost 30 people from a variety of fields. So we have pretty good skills in understanding business concepts of different types of ventures. And also from a portfolio approach, know a little bit, should we avoid this field or not? Some of the fields require very large portfolios in the numbers, and they require a different investment strategy. But in medtech, for instance, it's like building a company like you did it in the 70s or 80s or 90s. Very similar. Some parts go faster because you communicate faster globally today. But in other parts on how to build a venture, it's not so much different. And we'd like to invest in tech companies. That's the unifying concept for us. And in many of the new fields, you may have a technology but not a lead. So once you're out in the market, you have to not only move fast but also move right. Otherwise you won't succeed. And then normally you need a lot of money in that phase.
But do you think if we're talking about the bubble and everything like that, the companies, those kind of companies that they have users or someone who is engaged in the product, but they're not willing to pay yet. Do you still think that's a valuable company?
That's where we talk down the valuations the most. And there was a tendency in the fall. We got in many companies of that type, and they talked about valuations of 30-40 millions being startups, and that's pretty high. And they could also show that by pricing their service to zero, They had a lot of users. Well, that's no sign of real demand, is it? And we just declined, explained why, and actually some of them, a few of them, came back much later, but then the valuation had gone down significantly. But the problem in trying to hold on to a too high valuation is that investors that are interested in the beginning and decline because of the valuation may have invested in something else when you come back. And that happened in this case. We've invested in 4 ventures this year. So some who came back found that we had invested in some medtech, for instance.
What would be the dream company for you to invest in?
Well, I still wait for that company which make me rich. And I'm not talking, I think I'm on a sound economic footing. But, I have 2 daughters and 4 granddaughters.
Wow.
And that kind of rich, that I can be generous to them. So that I'm waiting for. I'm not quite sure what kind of company it would be. But we've invested, or in this week we are signing up in a company which I like very much. And I like it for different reasons. It's a medtech. It is creating a new way of testing out pharmaceuticals. And it has a founder that I sincerely like and feel related to. I can see that this is a man who got ideas early, went to the US and did some research there, returned here, continued to do research under bad circumstances, and he did not give up. He believed in this. And so I feel related in that sense, because I have been doing research myself, and it's not always been easy to find financing and so on. So that I would pick as my dream candidate, possibly.
Cool.
I haven't
invested much. Do you think
invested
a lot
much.
of startups, companies, do you think they miss the part about being actually on a personal level, kind of liking their investors and having that kind of something in common? Do they miss the people part?
I think that's the ideal business angel, actually, one who invests with both the brain and the heart. Because then you have the perfect setup for the struggles ahead. And when I teach and give seminars, I say that there is one common risk for the investor and the founder in the first round if it's a startup. And that's not to be able to get the second round financing. And that means that unless you form a partnership based on fair deal principles, then it's likely to fall through if the second round has bad circumstances, like you haven't done what you said you would do in that first year and so on. So, and founders of ventures, they don't think that way, but I think they should. Business angels are different from venture capitalists in that sense. It doesn't mean that venture capitalists don't have hearts when they invest. It's just that if you're a startup, there are other types of deadly struggles ahead. than if you invest after market entry. And most venture funds belong to that category, second category in Sweden.
And it's also often not their own money. It's someone
It's
employed
not their
by
own money. And that has actually, when I teach here my business angels, I say that there are two aversions that affect our likelihood to invest. And one is risk aversion, which is a well-known concept among economists, 50 years perhaps. And then there is loss aversion, which is a concept introduced by experimental psychologists, I think around late 1970s or early 1980s. And one of them, who survived the other, got the Nobel Prize in, I think, 2002 for their findings. And loss aversion is very much what is influencing you. For instance, when you go to a lottery, or if you invest in ventures that are not predictable. Because if it's not predictable, it's kind of a lottery situation, but the odds might be better. And then you have a different strategy for your investments than if you have some predictability. And if you have some predictability and, as we do, have skills that can help out the founders when they come into a difficult situation, then you have both predictability and some controllability. And that helps out when you invest. So founders who come with a need to get help, they might find that here, but if they have a group of small passive investors or go to Kickstarter or funded by me, they don't get that with their investments, with their money. So that's our distinct differentiation in this early stage market.
Is your model unique, do you think?
In parts, I think it is unique. I think I have found a way of building a thought system, a structure of your own thinking that is pretty unique. And it's hard to learn. I mean, this book, I've taught it to students, and I have some very ambitious angels, and they say, it's really difficult. But the difficulty is not in each part, really. It's in the structure, and it's in understanding some of the concepts. For instance, I introduce in the book the concept of entrepreneurial rent. And entrepreneurial rent is if you come with a new technology, you have a time advantage over competitors until they have picked up a similar technology. And that gives you a monopoly rent for a while. And the monopoly rent, the durability of that differs a lot between venture types.
Oh, yeah.
So what I have done is to kind of get a system for understanding how such differences work in the market. It does not teach you really a foolproof system of investing, but it makes investing more interesting. You think you understand why you prefer that venture to that venture. And I think that has helped me keep my interest in the field. And as you can see, I've been there for a long time.
Yeah. So from an entrepreneur's perspective, what should they look for in a good business angel?
Some features that complement themselves not only with the financing,
but in skills and
in skills. And if you take out an entrepreneurial team of 2 to 3 founders, generally you can say they lack skills in financing. So that's one thing. But the fact that you have finance from a variety of sources does not mean that they are the same, because they can provide the same degree of money. And for instance, if you go to a government funding agency like Almi Invest, they invest the taxpayers' money. And this means that they might have some kind of risk aversion, but they don't have the loss aversion because it's not their money. If you go to a venture fund investing in early stage, well, they have co-invested, but just a tiny proportion of the fund. So they lose the fund investors' money, not their own. But if you go to a business angel, he loses his own money. So it makes a difference in how you react to different things. And there is a field in economics that is relatively young called behavioral finance. And a lot of it, as taught at the universities, has been about the financing instruments. But it is also a lot about behavior. And behavior, as you know, is very different between people. So understanding that, unfortunately, the disadvantage of founders is that they are young. And it means that behavior to them may be difficult to grasp when they look at different investors. So maybe have somebody close to them come along to the discussion with investors. Might be a good idea.
To get a second opinion, or?
Yeah, you and I, when we talk to each other, we experience ourselves and the other person in one way. But Steve here experiences us differently. And then to compare afterwards gives you new perspectives. And maybe these perspectives are very important for a founder. So that's what I'm saying. So, and in that sense also, this guy that I admire so much, he's been a venture capitalist in Silicon Valley from early or mid 1970s until maybe 5 years ago. Then he became a senior advisor to 3 venture funds and a business angel. I mean, the guy's brain and heart works as when I first started to interview him in the mid 1980s. And why is that? Why is he able to capture what is happening in the field? Well, this is a field of learning, If you're hungry to learn more, the brain does not get affected as much. It may be more difficult with the new fields, but if you avoid investing in game and gaming ventures and figure out what will they need in forms of the platforms and the technology behind that and the internet and so on, then this guy would have the skills to know particularly which components or specialized software might be of interest to develop. Yeah. So that's what learning does over time, and since I'm an economist, I kind of get a lot of insight in new technologies, but it doesn't stick up here. But, when it comes to the various business concepts or how it might work in terms of the economy of the new technology, then I think it sticks almost immediately, and that's because I have written all these books. So in Sweden we are very concerned about the age of people, aren't we? I mean, my wife tells me all the time, why did that person talk so much about age and aging and ailments and sicknesses and blah 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 blah. And in the US, when I go there with her, they hardly speak at all. You see people work until they die as a lifestyle. And we don't have that as much in Sweden. We have to have a prime minister to tell us that we can actually and should work until we're 75. But why does he say that? Well, he wants to save the pension system, for God's sakes. It's very different from saying you should work until you're 75 or longer if it's good to you and if you're interested, if that's the lifestyle you'd like to live. And that's one thing I admire in the US, that they have such a freedom of thought. Not so much planned as we still have here.
That being a business angel has to be a lifestyle?
I think that's good if it becomes a lifestyle, for the simple reason that then you understand that you're in the game for the long term. You have to ask for the return on investment, and that's important. You don't do it because of the heart only, but you have calculated your numbers so that you think you will at least get the money back, so you can invest in the next venture. So it becomes a lifestyle, I think, if you do it that way. And I have to handle the interests of these close to 30 angels with different skills. And we had a period here when we got a lot of biotechs referred to us and with high potentials. And so we started to invest in biotech more. In the first fund, we only had one biotech, and that gave very high returns. And so we started to invest in biotech, and then we have lots of people in ICT. Well, what do you do? And we had to remind them every venture that came up in ICT, well, it looks good, but it won't yield as high returns. They are too highly priced, and so on and so forth. And so in that sense, we have a handicap as well as an advantage, depending on how we look at it. And the philosophy of our second fund is that we are a contrarian investor, in the sense that we always primarily look for the return. They can invest in the ventures that we reject privately, and we also can help them to design the contract with the founders. So there are many advantages like that we provide beside the high returns. But as a company, we have to be very careful to produce the returns that makes our investors continue investing.
So there's a lot of money coming into the market. And my question is it smart money? And if it's not, isn't there a risk in taking in an angel who doesn't have the network or experience? Isn't that the same as kind of investing in a first-time entrepreneur?
Yes, there is a danger, and that's, we are 4 general partners, and we believe that we have a mission outside of this group. And that's why we have set up company to educate. I used to do it myself from my own company, but now we're going to try to help out in the market more, because we've noticed over the years that the reputation we have got as a cautious investor attracts other investors. And it's the same thing as Niklas Zennström. Everybody has seen his success stories, Skype and other. And therefore, they'd like to co-invest with him. None here have that kind of reputation. But as a group, they know that we're cautious. We don't invest unless we have done a thorough analysis. Well, we'd like to have more people who are knowledgeable, because that's helpful in the market. And since I have seen the growth of Silicon Valley since the early 1970s, I've learned that the more money that comes into the market, the more ventures there will be. You get bumps like the millennium bubble and the bust after and so on. But the long run trend is that it's healthy for the market, that there are more money from skilled people. It's when there is money which is not smart that overfloods the venture market. That's when the bubble comes. When I talk to experienced venture capitalists in Silicon Valley, they said it was when the finance people came and wanted to become venture capitalists that the bubble developed.
Yeah, they came over from kind of the financial instrument side and went over to seed investments, which is about people, and didn't understand the difference. And I actually had this conversation yesterday that it's actually really difficult. And when you don't understand the difference, you're going in with the kind of wrong set of tools. I understand that I'm not an analyst. I would never go into the stock market. I would have someone do that for me, because that's not my field. I know that my skills are in the people section of doing business. And that's where my experience is. I've been building businesses for 10 years. So I understand what a founder goes through and what kind of challenges they have in that stage. And it's kind of dangerous when people think that they can evaluate companies on a seed stage and the kind of people risks that involves, the same way they try to analyze something, a company after an IPO.
That brings me to a topic. Warren Buffett is considered to be the best investor in stock markets that has lived, and he started as an intelligent investor when he differentiated between the analysis of the business case and the analysis of the stock itself. And so that's what I teach here. You have to make a distinction between the two. So the investment case analysis is something different. The problem we have in our field, and that Warren Buffett does not have, is that we don't have liquidity in the stock we're buying. There is a host of financial instruments we can use, and the contracts includes what's called real options, paragraphs which has economic impact, and some of the impacts are really big depending on the situation. And then on top of that, we have that the entrepreneurs are much more influential for our future profit than the leadership of a listed company. Because they can always be sacked and the company will continue to develop. But here we had a very early experience, by the way, with a company that had just recruited a professional CEO, and when we were invited to co-invest with 3 earlier and larger investors. And that CEO quickly recruited 2 specialists in software development. They needed in this company 2 different fields to combine. And then shortly after, he resigned for a better job and recruited somebody with very good marketing skills. But that guy could not analyze which one of the 2 specialists who claimed they had the solution for the next stage of software development, which one would be the best to trust. And he unfortunately picked the one who in the end was found out to be wrong. So the other one left and the company went under. So just 2 people like this can be very instrumental to life or death of a venture. And it was a venture in a very promising new field. And within 1 year, you could see the homepage for an American venture that started in the same field with the same concept. So that was an important lesson. Now we have actually we are adding to my own theme seminars various internal seminars that our shareholders can provide. And we had recently 3 of them that provided their experience in how to select people. So we'll see if that will become a theme seminar that we can also offer outside of our group. But in principle, we don't do the thorough evaluation of the founders until they come up to the late stage in our consideration. Then enough people have met them, and you have various perspectives and so on. And the general partners are generally older than the other partners we have, so they tend to understand people's differences better. But, in the end, we do invest in people. So,
do you think that's one of the differences between now and like the last bubble, that the investors understand people risk better?
I think so. I think that's at least for investors who have been there for a few years. But as you know, the last 2 years have seen many new investors in the market. Some of them have earned their money outside, and a few of them have come back from working in big investment banks and so on. And they know a lot about financing from an engineering point of view. May not know so much about people, how to evaluate people, or the trade they invest in. So it's as you know, money talks, and there is a tendency that those with a lot of money try to impress too much power on their side of the evaluation or the valuation of the venture, instead of trying to kind of stay a little bit away when you do the valuation and the structuring of the deal, and try to look at the other side of the picture. And that is the founder's view, the incentives remaining to develop the business.
Do you think some of the new investors kind of take a too big piece of the cake?
I think some of the new investors risk doing that. And I can see that we are 4 general partners here, and often we end up in discussions about what valuation we should have. I've gone through 2 different companies where people who have the skills and the models on their computer want to calculate the right value you attribute to a venture. And there are various criteria used for stock market businesses. And if you apply those on startups with hypothetical developments in the business plan, you end up in so much difference in the valuation that you can't imagine. And just a little thing happening before the market entry throws all these valuations up in the air, and you have to restart the calculation. So I think that when it comes to valuation, there is no right value of a startup. And therefore, the principle of a fair deal that at least experienced venture capitalists in Silicon Valley like to continue to work with has the right attitude and perspective, because then you say that let's try out with this valuation and adjust it with the following rounds according to how the venture develop. And that's what the stock option system allows you to do. And we don't have the legal framework for that. Only recently they have started to discuss it politically. But this means that in Silicon Valley, they work with 2 valuations of each startup. And here you don't hear people understand or say that there are actually 2 values of the startup. One, when you have common shares, which the founders have, and stock options in common shares. And one which is valued with the preferred shares, which the investor has. And in a Silicon Valley startup, the preferred shares are valued 10 times higher for a startup than the common share. And the tax authority has accepted that. You know, and then they have also other tax considerations. So therefore, if we would have that system here, it's likely that the startup valuations would fall in if valued with the common shares, but rise if valued with the preferred shares. And as the business develops and goes to a stock listing, those valuations approach each other. And in the IPO, there is no difference between share types anymore. And if there is a trade sell, they disappear as well. And the treatment of stock options distinguish between skills needed because we need a lot of hardworking people. So they are employee stock options. Everybody gets them. And then there is what they call qualified stock options. I prefer to call them milestone options because you have to reach certain milestones. Otherwise, they don't have economic value. And they are only allocated to people that could make a real difference, like the boss of sales and the CFO who has to arrange the next round of financing or something like that. The head of technology. So, and those stock options and the shares they get when the stock listing comes, they have to keep for half a year after the stock listing. And that's because the person is regarded as a key person for the new investors. So they have thought through the entire sequence of things that has to happen in order to bring out a huge company. And we don't have that still, you know. I started to talk about stock options in the late 1970s and the importance of them. And I have been 15 years in business organizations and nobody took an interest. And I've held so many speeches to top people in the ministries and politicians about this, and it's been impossible to get any political interest in doing something. Until now, I saw recently that Annie Lööf has picked up the influence of stock options. But if one political party, you know, gets an interest in it, it tends to block out other political parties. So it has to be a broad understanding of why they are important.
Yeah, we get a lot of startups who come to us in a pre-investment stage, and we help them with finances and budgeting and preparing for investors. And they think pretty much that whatever they read on TechCrunch is how it works in the startup world. And they're so baffled when we tell them, like, no, it doesn't work the same. That's American laws. That's not how it works for a Swedish AB. For example, with vesting. And yeah, you just have to like flip around their whole idea about how to manage that part.
We tried to do it in other ways, but it's more costly for both sides to do it in other ways. And then there is also the difference that in order to understand how you should design it, you have to do a deeper analysis and a better communication with the founders. Otherwise, you know, you get a reaction, why do we have to do this so complicated? We just need money.
Yeah, so thank you so much, Lennart, for coming here today and being interviewed. It was so interesting to hear from such an experienced business angel.
Thank you. It was fun to be interviewed.
You've been listening to Lennart Ohlsson of the Stockholm Business Angles talking with Xue Mei Rhodin. If you want more information about the Stockholm Business Angels, you can visit their website at www.stoaf.se. That's spelled STOAF. If you want to learn more from Lennart, you can go pick up his book, Best Practice Venture Capital: Principles, Tools, and Approaches for Investment, Strategy, and Policy. Again, that's Best Practice Venture Capital by Lennart Ohlsson. Are you wondering about what the next step for your startup is? Maybe you're facing a new problem and you need help to push through and keep growing. I'd like to invite you to come book a spot at our open office hours and speak with a business advisor. You can claim your spot at startupcabin.com/office hours. That's all for today, and until next time, we wish you much success.